This move is not normal. Silver is not supposed to move like this right now. Not in the last trading days of the year. Not when liquidity is thin. Not when desks are empty and volume is drying up. And yet, during overnight sessions, when almost nobody's watching, silver quietly moved 4 to 6% in short bursts. No headlines, no panic, no excitement. That's the problem. Because when markets move without attention, it's never random. It means something is adjusting underneath the surface. Here's the uncomfortable question. If nothing mattered this week, why did price bother moving at all? Because markets don't usually behave like this when nobody's supposed to be around. Liquidity is thin, desks are half empty, volume is light. And yet silver is not acting sleepy. It's acting aware. It's moving with intention, not excitement. Small percentage shifts, 4, maybe 6% in short bursts, appearing where silence usually lives. That's the first belief break. Year-end trading weeks are designed to close books, not open risk. Most players reduce exposure, not add to it. But when price moves without volume, when volatility appears without a crowd, it tells you something structural is happening underneath the surface. Not loud enough to trend, not aggressive enough to scare, just enough to reposition. And that's where people get it wrong. They think nothing is happening because headlines are quiet. They think nothing matters because it's the holidays. But markets don't need noise to move. They need imbalance. And imbalance loves moments when attention is elsewhere. Look at the calendar. These are the final trading days of the year. Asia hours roll into Europe. Europe hands off to the US, but participation is uneven. Overnight sessions carry more weight than they should. Small flows can push price further than usual. That's not manipulation. That's physics. And silver, more than most assets, responds to physics. Because silver trades in two realities at the same time. One is fast, digital, leveraged, and liquid on paper. The other is slow, physical, and sticky. When these two realities drift out of sync, price becomes sensitive, not explosive, sensitive. That sensitivity shows up first when nobody is watching. Here's where belief breaks again. Most people think big moves start with big volume. In reality, the most important moves often start when volume disappears. When liquidity is thin, price discovery becomes fragile. A small decision made by a few participants can travel further than intended, especially in metals where positioning is often carried, not traded. So when silver moves quietly in the last week of December, it's not a breakout. It's a signal, a test, a probing of structure. Ask yourself this. If nothing mattered, why would price bother moving at all? Now, zoom out slightly, not years, just weeks. Silver hasn't been exciting. It hasn't rewarded impatience. It's been compressing, frustrating both sides. That's not random. Markets don't punish both bulls and bears unless they're trying to reset expectations. And expectation resets happen before positioning changes. This is where psychology enters. Most retail participants are disengaged right now. They're traveling, spending, disconnecting. Many funds are done for the year. Performance is locked. Risk managers don't want surprises. That creates a vacuum of attention, and attention vacuums allow structure to breathe. In those conditions, price doesn't need consensus. It just needs permission. Watch how silver has been moving, not in straight lines. Short advances, shallow pullbacks, no follow-through headlines, no excitement. That's not how speculative moves look. That's how inventory adjustments look. Paper contracts can change hands instantly. Physical exposure cannot. When year-end approaches, balance sheets matter, carry costs matter, settlement matters. And when those pressures align during low liquidity weeks, price starts reflecting stress points rather than opinions. That's uncomfortable for traders who rely on signals, because there's no clean signal here, no indicator screaming buy or sell, just behavior that feels off. That feeling is the message. Another belief break. People assume if something important were happening in silver, gold would be leading loudly. But silver doesn't always follow gold in timing. Silver often reacts to different pressures, industrial flows, hedging behavior, inventory considerations. Gold reflects confidence. Silver reflects friction. And friction increases quietly before it becomes visible. Look at intraday behavior, moves appearing during Asia hours that don't fully retrace in Europe. Small gains held instead of sold. Volatility expanding slightly while volume stays muted. That mismatch matters. Volatility without volume suggests price is being allowed to move, not forced. Allowed by whom? Not a villain. By structure. Markets or systems. Systems adjust when inputs change. End of year changes inputs. Reduced participation, different risk constraints, different objectives. When the system adjusts, prices realign. Now here's the part most people miss. This is not about predicting what silver will do next week or next month. This is about understanding why it is behaving differently now at this moment when logic says it shouldn't. Because when behavior changes before narrative, narrative always arrives late. Think about positioning. Many participants carry silver exposure as a hedge, not a trade. They don't watch charts every hour. They rebalance at specific times. Year end is one of them. tax considerations, accounting rules, inventory reconciliation. Those flows are invisible until they aren't. And when those adjustments occur during low liquidity, price responds faster than expected. That's why you get these sudden 4 to 8% shifts that feel unjustified. They aren't driven by news, they're driven by necessity. This is also why reactions are muted. No panic, no euphoria, just adjustment. If you're waiting for a confirmation from headlines, you're already behind. Another uncomfortable truth. The paper market can absorb pressure quickly until it can't. When it can't, price jumps. Not because demand explodes, but because offers disappear. That doesn't require a crisis. It requires imbalance. And imbalance loves quiet weeks. Notice what hasn't happened. There's no broad retail interest, no trending keywords, no excitement on social feeds. That's not a sign nothing is happening. That's a sign this phase isn't meant for participation. It's meant for alignment between exposure and reality. This is where timing matters more than theory. People love theories about silver, industrial demand, monetary hedge, green energy, all of it. Those stories don't move price in the short term. Behavior does. And behavior right now says silver is being handled carefully, not ignored. Careful handling shows up in price being supported during odd hours, in dips being shallow, in recoveries that don't chase. It's subtle, easy to dismiss, dangerous to ignore, especially at year end, because the last trading days set the emotional tone for the first weeks of the new year, not directionally, but psychologically. They condition participants. They establish what feels normal. If silver ends the year behaving differently, that difference carries forward. And here's the tension. Most viewers are trained to look for conclusions, breakout or breakdown, bullish or bearish. But markets don't offer clarity on demand. They offer clues. Right now, the clue is discomfort. Discomfort because the move doesn't fit the calendar. Discomfort because volume doesn't confirm volatility. Discomfort because nothing obvious explains it. That's when awareness matters. Ask yourself again. If this move didn't happen by accident, what was it preparing for? Not a price, not a date, a shift in behavior. And behavior shifts before participation returns. As liquidity slowly comes back, as desks refill, as attention reconnects, price will already have moved into position. Not dramatically, just enough. Enough that late reactions feel sudden. Enough that narratives scramble to catch up. Enough that people say, it was obvious in hindsight. But we're not at hindsight yet. We're at the point where something is leaning but hasn't fallen, where pressure is present but not released, where the structure is whispering instead of shouting. And the most important part is this. The whisper is happening now when most people aren't listening. Because once everyone is back, once volume returns, once the calendar flips, the market stops whispering. It speaks clearly, and whatever it says next, it won't sound like this quiet tension you're seeing right now. It will sound decisive. And that's where this really starts to matter. Because when it speaks clearly, the reaction is never calm. That's the part people underestimate. They think the risk is missing upside. They think the danger is being late. But in markets like this, the real risk is misreading the phase you're in, treating a positioning phase like a conclusion phase, treating quiet adjustment like confirmation. Right now, silver is not inviting participation. It's testing tolerance. And tolerance is psychological. Think about how most people experience markets. They react to movement, not structure. When price is flat, attention fades. When price jumps, emotion rushes in. But the professionals, the ones who survive long enough to matter, they watch the opposite. They watch what happens when nobody cares. Because that's when decisions are clean. No crowd, no pressure to perform, no need to explain. Just exposure aligning with reality. This is where awareness shifts. If you've been conditioned to wait for excitement, you will miss this entirely. If you've been trained to look for confirmation, you'll arrive after positioning is done. But if you understand timing, not as dates, but as behavior windows, this moment stands out. Year-end is not about prediction. It's about reset. Books close. Risk is recalibrated. Assumptions are quietly challenged. And assets that don't fit cleanly into narratives get adjusted first. Silver is one of those assets. Too industrial to be purely monetary. Too monetary to be purely industrial. It sits in between systems. And assets that sit between systems always feel tension first. That tension doesn't explode immediately. It tightens, like a spring being tested, not released. Each small move checks resistance. Each shallow pullback checks supply. Nothing dramatic, nothing obvious. Just pressure building in increments small enough to ignore. Until it isn't. Here's the key psychological shift. Most viewers want to know what to do. That's not the right question right now. The right question is, what phase is this market in? This phase is not distribution. There's no urgency to exit. It's not accumulation either, at least not in the way people imagine. There's no aggressive buying. This phase is alignment. Exposure, moving into places where it causes the least friction. Alignment phases feel boring. They feel confusing. They feel like wasted attention. That's why they work. And because this is happening during a holiday week, During low liquidity sessions, during hours when most eyes are off the screen, the alignment happens with minimal resistance. That's not an opinion. That's how systems behave. Look at the way reactions are delayed. Price moves, then pauses. Instead of immediate continuation or rejection, it holds. That holding behavior matters. Holding means there's no rush to unwind, no panic to take profit, no fear of being wrong immediately. That calmness is artificial, not fake, but temporary. Because calm built on low participation doesn't survive when participation returns. As we move out of the holiday environment, volume will normalize. Attention will come back, and when that happens, the same price levels that felt stable now will feel exposed. This is where awareness separates from comfort. Comfort says nothing is happening. Awareness says something is being prepared. Prepared for what? Not a specific move, a reaction. Markets don't move when everyone agrees. They move when expectations collide with reality. And right now, expectations are low, almost non-existent. That's fertile ground. Another subtle detail. Notice how silver isn't overreacting to other markets. It's not chasing risk on, not collapsing on risk off. It's acting independently. That independence is rare. And rare behavior always precedes repricing, not because of fundamentals, but because of perception. Perception shifts when something stops behaving the way it used to. People don't need to know why. They just need to feel it. And once that feeling spreads, behavior changes quickly. That's why the most dangerous moment isn't now. It's later, when the narrative forms, when explanations appear, when confidence returns. That's when people overcommit emotionally. Right now, there's no emotion, just quiet adjustment. This is also why you won't hear clear opinions from those who are paying attention. Silence is a position. Waiting is a strategy. Observation is not indecision. If you're looking for certainty, you won't find it here. If you're looking for signals, they're subtle. If you're looking for comfort, this isn't the place. But if you're looking to understand how markets actually transition from one state to another, this is a live example. Silver isn't sending a message to everyone. It's sending it to those who notice timing mismatches, who notice volatility behaving differently than volume, who notice price holding where it shouldn't care. And that message isn't bullish or bearish. It's alert. Alert that the easy assumptions may not hold. Alert that the quiet period is doing more work than the loud one. Alert that when participation returns, reactions may feel disproportionate to news, because the work will already be done. That's why you don't need predictions right now. Predictions anchor you to outcomes. Awareness keeps you flexible. Flexibility matters more than conviction in transition phases. As the calendar turns, as liquidity rebuilds, as attention shifts back to screens, silver will no longer be moving in a vacuum. It will be moving in a crowd. And crowds amplify moves, not create them. Creation happens in silence, this silence. So when you see people suddenly talking about silver later, when explanations feel rushed, when confidence feels loud, remember this moment. The end of the year, the wrong timing, the quiet adjustments. Because by then, the market will already be in motion. And awareness doesn't mean acting. It means not being surprised.